Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 25th of November. It's been a mixed week in markets, generally positive. There's been a couple of factors at play. It would be remiss not to mention Nvidia in the US, probably the largest company in the world now, certainly a AI market darling and something of a poster child of all things AI. It's an interesting reaction to their quarterly results, which beat quite comfortably in terms of revenue estimates, but by the same token there was some disappointment in terms of its revenue forecasts for the current quarter, and that just shows the weight of expectation which is continuing to grow when Nvidia has seen its share price rise by 850% over the last 2 years and around 200% in this year alone. Elsewhere, that's prompted something of another look at the so-called Magnificent Seven. There's been a bit of rotation out of those technology stocks, looking for other areas of the market which could benefit from any measures coming from the new Trump administration, such as cyclicals and indeed smaller caps. In terms of the UK markets, it had a reasonably good couple of days. Part of that is indirect, in as much as there's been some more dollar strength and therefore sterling weakness, and of course in terms of FTSE 100 companies where the majority of earnings come from overseas, those profits are therefore more valuable when they're repatriated. So in the year to date, the Dow Jones is currently up by 16.4%, the S&P 500 by 24.7%, the Nasdaq by 26.4%, and the FTSE 100 is ahead by 6% so far. Looking ahead to next week, 3 companies reporting, each of which have had a pretty good time of late for different reasons. Firstly, there is a third quarter update from Kingfisher. Shares are up about 25% over the last year. Obviously, this is known in the UK for its B&Q brand, but the real jewel in the crown, and for some time now, has been Screwfix, which the company is trying to expand into an overseas mode. When we last heard from them at the half-year numbers, Kingfisher reported that the UK and Ireland was trading pretty well. Europe, not so much, especially weakness at its Castorama arm in France. So one of the things to look out for, there's also a cost reduction programme of about £120 million expected this year, so we can look out for some updates on that, as well as trading in the UK and Ireland in particular. Half-year numbers from AO World, shares up 30% over the last year. This is a business which decided to exit its German operations and just concentrate on the UK. By the same time, it's an online-only business, so it doesn't have the store portfolios of some of its competitors, which can, of course, be a plus and a minus. But major domestic appliances, or MDA, which are its main line of sales, will be a particular focus, as well as the ancillary revenues it gains from elsewhere. And finally, full-year numbers from easyJet. Shares up about 23%, but in terms of just pointing out how difficult the airline sector can be to invest in, if we go back pre-pandemic, over the last 5 years, the shares are still down by 54%. That being said, more recently, they've been on something of a roll. In terms of passenger revenues, clearly they're going to be in focus, but also ancillary revenues, where easyJet are charging extra for the likes of food and baggage, for example. One other point to look out for, easyJet Holidays, pretty much from a standing start. It now accounts for some 13% of group revenues, and when we last heard from easyJet, they were saying that the profit contribution for the full year from easyJet Holidays could be as much as £180 million, so that's one to keep an eye out for. Thank you for watching. Have a great week.